Okay, well, after that brief interlude, allow me to welcome our distinguished panel to the stage. We have Andrea Beltramello, head of the freshly renamed Savings and Investment Union Coordination Unit at the European Commission's DG FISMA. And we have Judith Arnal, senior fellow at the Centre for European Policy Studies. I got that right. Perfect. Okay, we've identified plenty of the issues in the interview that we've just had about what might be blocking and clogging up the investment channels in the EU. Judith, I'm going to come to you first. The issues that we're talking about, is the investment picture really as bad as people say in the EU?
I don't think it's as bad, and please allow me to break 4 myths very quickly. So first one, I think that we're all obsessed about the size of the MFF, about lack of fiscal space in our budgets, and we must realize that most of those investments will have to be funded by private sources. So we really need to focus our attention not on political battles about size of public budgets, but about how to channel those private funds and how to stimulate them. Second point, and second myth I want to break is that we are not able to keep our savings at home, and that 300 billion euros, according to the Letta report, of household savings leave the EU every year. Well, that's simply how a balance of payment works. So if we have a current account surplus, of course our savings will go abroad. So basically, we have to stop being obsessed about having current account surpluses, and then we will keep those savings. Third point is that the Savings and Investment Unions is simply an EU project. And I think that there is a lot of homework to be done at member state level, and I think that the Commission is launching the right recommendations, like with the Savings and Investments account. Also, there's a lot to do with pensions to promote Pillar 2, Pillar 3 pension systems, and I think that tax incentives have a clear role to play there. And last but not least, there are some people who think that banks are against the development of capital markets in the EU, and I think that's not the case. And I'm fully convinced that having a truly functioning banking union will help develop a capital markets union. Why is that the case? Basically, we have more assets under management in the EU than in the US. More than 30 trillion euros of assets under management in the EU compared to more than 20 trillion euros in the US. The problem in the EU is that our investment funds are fragmented, and that's basically because those are channeled via banks. If we achieve a banking union and we have European champions, then our investment funds will also grow, and we'll have stronger institutional investors.
Andrea, there's a lot in there that I'm sure you'll want to respond to. Maybe if there's anything you want to respond to there, and also maybe you could walk us through what are the main initiatives that the Commission is doing to try and fix this problem. You have the unenviable task of being the technicians trying to fix the EU's financial plumbing.
Well, it's hard for me to add to what Judith said because I basically agree with everything she said. What I can say is that, at least from the Commission side, we are trying indeed to address the challenges that Judith just presented so eloquently. Clearly, we have the savings in the EU. Europeans are among the best savers in the world. But the issue is that at the moment we have 10 trillion euros in deposits, and that's nothing bad with that because those deposits are actually used by banks to fund the economy already, and because people need deposits for the safety, the liquidity, and so on. But we could shift at least part of those deposits into capital markets. That will make a great contribution to filling that investment gap that Draghi has so well documented in his report. The issue is that, so we have the savings. We have actually also the business case for investing in Europe because we have a lot of good investment opportunities in Europe. A lot of innovative companies, startups, growing companies. So the business case is there, but we have an issue with the financial intermediation, which is not working. We have a problem of fragmentation. Our capital markets are too fragmented, too underdeveloped, too small. We have more than 300 trading venues, a lot of post-trading infrastructure, a lot of small investment funds, very fragmented. So we need to act on that. We need to improve the plumbing, as you put it, of our financial system and ensure that this conveyor belt between the savings and investment is working as efficiently as it's not doing at the moment. So we are doing that indeed through several work streams that we will we will put on the table by the end of this year. We already started the other day with our recommendation on savings and investment accounts, on financial literacy, so really to mobilize more investment from retail investors. We have the pensions package coming in November, where we will at the same moment improve the opportunities for people to have better income in retirement, but also ensuring that pension funds can more easily deploy their firepower into the economy. And finally, by the end of this year, we will come with our package that will address all these inefficiencies that we still have in our capital markets, and removing these barriers that create a lot of fragmentation.
It's nice that you raise the idea of efficiency and inefficiency, because I think one of the main complaints that we often hear is that investment's not flowing around the EU, also just because the regulatory landscape is so complicated. And obviously, there's this big push from the Commission to simplify lots of things at the moment, initially on green finance, but potentially for other finance areas later. Judith, why is FinReg so complex in the EU? And I mean, is this really the issue that industry and other actors might make it out to be?
I think that this is something that we should really work on. And first, I think that we should diagnose why our regulatory landscape is so complex. So I would list 5 main reasons. First one is that there are too many mandates to level 2 and level 3 levels. I mean, there's been an explosion. In the 90s, one could claim, I'm an expert in financial regulation. Nowadays, it's impossible. You can be an expert in a very specific subset of financial regulation due to...
We still try.
the amount of level 2, level 3 pieces. And the second point, this gets me to my second point. Why is this the case? Do we love regulation? Well, I think that this is very much linked to governance. So we have 27 member states with 27 national competent authorities. So the way to ensure a bit of coherence and the internal market and that the internal market works well is to have hyper-detailed legislation. And even with that, many times we still have national competent authorities doing different things. The third reason I would say is gold plating by member states. Member states love to gold plate. I think that the shift from directives to regulations has somehow helped improve this, because now there is no transposition in national parliaments, but even with regulations, now gold plating practices have moved to the Council. The fourth point, I think, is that we need to improve how we assess regulations. So the European Commission usually does impact assessments, but then when it goes to the co-legislators, a lot of amendments are introduced and there is no impact assessment of that. So we don't really know how that regulation is going to work. And then I think that there should also be ex post assessments on a regular basis, and this really doesn't happen. And finally, I think that our rules are very much focused on financial stability and consumer protection, with which I agree. But I think that it's also time to think about the possibility of introducing secondary objectives, like other authorities are doing in the UK. We could think about financial competitiveness, financial sector competitiveness, and this is not at odds with other primary objectives. I am convinced that they can be self-reinforcing.
Andrea, does simplification need to be a key part of boosting investment in the EU?
Absolutely. As you know, simplification is a very important priority for the EU and for the European Commission as well. And I think in the area we're discussing, we have a great opportunity for simplification with this reform package that the Commission is going to present by the end of the year on market integration and supervision. We have at least 4 areas in which we can work for more simplification, and they are all interrelated. So first of all, we have financial actors in the EU, in all these sectors, in trading, in post-trading, in asset management. They are active across different member states. Basically, they act as groups, but they are not actually recognized as groups. So in practice, even if they have a pan-European footprint, they are treated as potentially 27 different entities, and that creates a lot of duplication, a lot of waste of resources for them, instead of concentrating on doing business. So that's one area in which we can do something to simplify already. The operations of these large entities across the EU. The second area is gold plating. So we know that one of the main issues is that because we have many directives which are transposed into the national legal frameworks instead of applying directly, this gives an opportunity to create a lot of layers of additional rules. So we will aim as much as we can to move provisions in the EU financial rulebook from directives into regulations, or even converting directives fully into regulations. The third area is about passporting. So as you know, one key pillar of our single market in financial services is the possibility for a financial service operator to be authorized in one member state and passport its services across the EU. Unfortunately, in many situations, this remains a theoretical possibility on paper. We need to improve the way the passport works. And last but not least, supervision. We have still fragmented supervision in the EU that leads to a lot of duplications, costs, and inefficiencies. So we have to explore how we can also simplify through a more coherent and more uniform supervisory system.
Judith, do you think those initiatives will be enough, or do you think there's more work that we need in other areas?
So I do really appreciate the work of the Commission, but the problem is that there are more actors involved. So I have the feeling that the Commission knows very well what they understand as simplification, but I'm not so sure that this is commonly agreed by other actors, and I'm thinking about member states, I'm thinking about the European Parliament, I'm thinking about national parliaments, national competent authorities. So I think that there should be first an agreement about how we understand simplification, and it should come from the very top. I'm thinking, for instance, about statement at a European Council level, and also a mandate coming from heads of state and government to limit the amount of mandates to level 3, and also a commitment for better impact assessments, also ex post assessments. The second point is that I need that there should be someone with a 360-degree view of what's happening in different files. And let me refer, for instance, to capital requirements, bank capital requirements, capital stack. I don't think that the industry is asking for lower capital requirements. I think that they are asking for more predictable and simpler capital requirements. Now, the different capital requirements stay with different institutions. So, for instance, some macroprudential buffers depend on national competent authorities, and sometimes they just come out of the blue, so there's no predictability. So I think that there's an effort that should be made in this regard. And last but not least, I think that in the medium term, we should absolutely go in the direction of pulling our governance systems together at the European level. I think that the single supervisory mechanism is a good example. Of course, it has now turned 11 years old, and I think that some aspects could be improved, but I think that this is the direction to go in the future.
Okay. For those who aren't maybe familiar with the ins and outs of financial regulatory architecture, the SSMs is referring to the fact that there's central supervision for the banking sector in the EU, but it doesn't really exist for the non-banking sector. Andrea, maybe you can touch a little bit more on the issue of supervision, because I think for a lot of people, this is an initiative talking about getting citizens investing. It's an initiative talking about having more of a culture in the EU. Where does a sort of obscure technical issue of who's supervising financial players that most of us don't interact with day to day, how does this really move the needle in terms of the overall picture?
Mm-hmm. No, it's a very good question, but it's important that we make this link, because ultimately we all pay for the fragmentation, the inefficiencies. So this is not an agenda for the financial sector. It's not like a gift to the financial sector. It's because if the financial sector in the EU works more efficiently, it means lower costs also for the final users of the financial sectors, the companies who are seeking finance through the financial sector, and the people who are investing, who are putting their saving into productive uses for themselves through the financial sector. So having a more efficient, less fragmented, less costly financial intermediation in the EU, it's really to the benefit of everybody. And that's where the supervision comes in, because, as I said, supervision can also be a barrier to more efficient financial intermediation in the EU because of all these duplications. and all these inefficiencies. And therefore, if we have a more efficient way also to supervise the financial sector, this will be to the benefit of all. And there are many ways to achieve that objective. In some areas, we have already tools for ensuring more convergent supervisory outcomes across the EU. So we have already an authority, the European Securities and Markets Authority, that works with national competent authorities and has already some tools to ensure that the supervision is done in a convergent way. But these tools can bring you so far, and we believe there is merit in assessing moving some supervision also to the EU level, in particular for certain entities that have a very significant cross-border footprint in the EU.
And I think some of the important context here is that historically this has been a very political issue, the issue of supervision of financial markets. It's very contentious. There's a bit of a political rift between EU countries, which has traditionally blocked progress in this area. Judith, are you optimistic that progress might actually come on a political level about central supervision?
Maybe in the medium term. I think in the short term, we could aim at other kinds of solutions. For instance, I think that the ESAs, basically the European Banking Authority, the ESMA you were referring to, and EIOPA for insurance and pensions, should be better resourced to carry out peer review processes and to test how national competent authorities behave. This should lead to a final outcome outlining who the bad outliers are, the national competent authorities who flag negatively in that impact assessment, but this should not stay at technical level. I'm convinced that this should go to ECOFIN and Eurogroup meetings. This should probably take the form of a statement where those national competent authorities are clearly flagged, and this should probably also feed into the European semester for those member states where national competent authorities are clear outliers. So to me, that could be a short-term solution, and I think that by aligning step by step the practices of national competent authorities, then the ground will be way riper in the medium term for a more long-term governance solution.
Yeah, it's interesting that you raise this point of linking the European semester to reforms, because, Andrea, I know we were talking about this earlier this week when the Commission was presenting its investment and savings accounts. Maybe you could talk a little bit about the interplay of how the Commission is actually making sure that these reforms are implemented when it's not, it's for the Commission to recommend, but it's for the member states to implement these suggestions.
Yes, I mean, there are some areas of the Savings and Investment Union that can only be achieved through legislation because they are like the let's say, initiative I was just describing. They're classic single market initiatives where you need a common rule book. But there are many things that can be done at the national level by the member states themselves. So, for example, to get more people to invest into capital markets, this is something that can be done through national tools. There are also areas which are very difficult to tackle at the EU level, where reforms at the EU level are difficult. I think about pensions, I think about insolvency regimes, I think about taxation, and where member states can really take the lead and take ownership in doing the reforms that are needed for the Savings and Investment Union. So this doesn't mean that the Commission wants to completely abdicate from our responsibilities. We are there to support the member states in these efforts, and we can give them recommendations. We can identify what are best practices that have worked in the EU, but also outside of the EU, as we did with the Savings and Investment Account just this week, provide these recommendations to the member states and accompany them in implementing them. And of course, it's not about naming and shaming, but it's about, keeping things on track, and we can do that through different tools that we have already at EU level, European semester being a very established tool that is precisely aiming at ensuring that we do the reforms that are needed for our competitiveness and our economic growth. And Savings and Investment Union should definitely be integrated more closely into the European semester process.
So we've talked a lot about how to generate more investment capital and get more money flowing in the EU. But what about making the EU a more attractive investment destination worldwide, about actually attracting some capital to be invested in the EU. What do you think could be sort of game changers here?
Well, to me, this goes a bit beyond financial regulation, to be honest, because it refers very much to business climate. So here we're thinking about the full Draghi report where we should tackle EU competitiveness at different levels. But again, it's not only about the EU. One thing that I don't like, the only thing I would say that I don't like about the Draghi report is that many times it speaks about EU averages. But if we have a look at member states' situation in the different elements that we think explain competitiveness, we see that there is high heterogeneity. And what we see is also that usually the top performers are the same. And I'm sorry to say, I come from Spain, so I'm happy to say that it's Scandinavian countries, usually. So I think that national reforms have a very clear role to play in making the EU a more attractive and competitive place. So it's not only about shifting the whole responsibility to the European Commission and to European institutions. Member states have a role to play. So here, I mean, Andrea was mentioning that the Commission launched a recommendation for a savings and investment account. I understand that there will be also a recommendation for pension systems. So this is something that the European Commission can only recommend, but it's for member states to react. So here, I think that communication and journalists have a very important role to play in conveying to citizens that this is a way forward, and to also encourage citizens to ask at their member state level, sorry, where's my savings and investment account? There's a recommendation here to have a savings and investment account with tax incentives. Where is it? So I think that the same could be done with other areas of competitiveness, also to have a civil society who asks accountability at member state level.
Andrea, same question. Boosting the attractiveness of the EU as a destination for investment, and can the Commission go it alone, or does it need help?
Well, I think Judith said a very important thing. It's not only about financial regulation, of course, but it goes without saying. But I think it's an important point, because the Savings and Investment Union, as I said at the beginning of my intervention, it's about fixing this conveyor belt between the savings and the investment opportunities. In doing that, we can, actually, we must make sure that there is something in it for the people, for the savers. So they need to see a good return. They need to see the wealth creation opportunity in it. And this will create a virtuous circle where they will want to invest more of their money. This will go more into the economic growth and jobs creation. But if we want also to attract capital from abroad, it means that the EU has to become an attractive business case. And this is not for the financial sector to create. There are many other policies that need to be put in place, and the Savings and Investment Union in that sense is a sort of enabler. So it's fixing the financial sector so that it channels the saving into the productive investment, but the investment opportunities have to be created through innovation policies, structural reforms, many other policies that can be fixed at the European level, but also very importantly at national level. So we really need to take a very holistic approach, and this is why, by the way, Savings and Investment Union is described as an enabler in the competitiveness compass of the Commission, which is, our compass towards a more competitive and growth-friendly EU.
And so we were hearing on the previous interview about the role that securitization could play in potentially generating more capital, having investment flowing more. I mean, just very briefly, each of you, what kind of a role do you think securitization could play in the wider picture of boosting investment? I mean, maybe I'll go to Andrea first, since you were just sort of touching on it.
I think securitization is a very useful tool. It can be really a great tool to free up banks' balance sheet and increase more funding for the economy. So that's why the Commission put such a big emphasis on it. That's why this is the first deliverable that we put on the table on the Savings and Investment Union agenda. And we hope that the Member States governments and the European Parliament will be as quick in following up on our proposal. But it's not the silver bullet. So it's a very useful tool, but it will not be the only one game changer in town. There are many other reforms that we need to do in order to be successful on the Savings and Investment Union.
And Judith?
I can echo Andrea's words. There's something I really don't understand, and it's why EU securitization markets are not working when, I mean, the financial crisis, the global financial crisis, it started in the US, so it was not, in the EU, it was not linked to EU securitizations. We must take into account that roughly 75% of funding for companies and households in the EU comes from banks. So basically, freeing up banks' balance sheets so that they can grant more credit is very useful. So I think that we should welcome the proposal by the Commission of last summer with some very welcome improvements and fine-tuning in our EU regulatory framework for securitizations.
Okay, well, plenty of food for thought there. Thank you both so much for your contributions. Let's have a hand for our panelists. Please do stay in your seats for the moment. Next, I will be inviting Doug Busvine onto the stage for the editorial takeaways from this session. Thank you again.
Hello again, everyone. Well done for making it through the morning session. I found it fascinating. And thank you also to Catherine, to all of you here for watching Politico's Competitive Europe Summit here in Brussels. And those of you tuning in online, I'm Doug Busvine, the trade editor at Politico Europe. Well, the third stream of the Competitive Europe Summit is drawing to an end. And yeah, we've heard from panelists on how Europe is rethinking its relationship with the USA, building new commercial relationships with other parts of the world, and redirecting its investment power to new sectors to build in-house economic growth. Well, I've got a few takeaways, and I've got to admit I'm stealing shamelessly from our excellent live blog, which I would really recommend that you take a look at. So we kicked off this morning in Camille Geiss's session on trade, with Matthias Jørgensen from the Commission saying, yeah, we're going to get a Mercosur deal signed in time for Christmas. That's been a long time coming. We had a scoop on that earlier this week, so it's nice to hear confirmation from someone who should know. Matthias Jørgensen is the point person for trade talks with the US and Canada. Yeah, also quite a feisty panel with Malte Lohen from the AmCham, taking a swing at the Turnberry Agreement, saying it's not an ideal scenario. Yeah, some might put it more strongly than that. But he also saw the positives. No deal would have meant 30% US tariffs, plus getting on for 100 billion in EU trade retaliation. And that would have spelled a spiral of escalation that really nobody wanted. Coming back to Matthias Jørgensen, I think there was concern expressed there about Donald Trump's attitude towards steel, widening the range of products that are subject to steel duties. That's something that the EU is looking at pretty closely, as we're also on the brink of putting in our own restrictions and new tariffs there. Yeah, just skimming through. Going to Antonia Zimmermann's panel there, we had some interesting views from the near abroad. So the Turkish ambassador, Faruk Kaymakçı, expressed some frustration that the customs union with the EU is over 30 years old, or 30 years or so old. Time for an overhaul, but it's just not going anywhere. And also, some frustration expressed that that the EU is not really involving Turkey, a NATO member, remember, in its discussions around energy, what to do about Russia. So that's quite important, and I think worth noting. From Kerry Morgan, the UK's trade lead. Yeah, she's welcomed the new chapter since that summit in May where they kicked things off again, calling for greater dialogue. Moving on to Gregorio Sorgi's panel on the long-term budget. Yeah, I was particularly interested by the Polish representatives' concerns about diverting funds to competitiveness and maybe away from cohesion, and whether some of the less affluent parts of the EU might end up losing out to the powerhouses. I also wearing my other hat as agriculture editor, couldn't help pricking up my ears when Jan Strasky of the OECD said we really need to rationalize the common agricultural policy. Does it really support farms where the money is most needed? We need to simplify the cap for recipients and administrators. And our corporate guest from Lilly, that's Marcel Le Chanteur, yeah, he looked through some of the rhetoric and the contortions we're seeing on tariffs from Trump to make the point that it takes us several years to build manufacturing sites. It takes months to get regulatory approval. So we don't make those decisions in short order. But what he does say is that by any standard, the US regulatory decisions go much faster than in the EU. Well, you've just heard Catherine's interview and panel, so I won't reprise that. But what I will say before we break for lunch is to thank our speakers who participated this morning, as well as our moderators and crew. I'd also like to thank our partners for making the summit possible. So here we go again. Leading partners are ASML, Bayer, FPA, and Google. The presenting partners are Lilly, DP World, Revolut, and Santander. And the knowledge partner is the McKinsey Global Institute. We've had lots of food for thought this morning. Now we'll have actual food. Outside, we have a networking lunch set up to run. I guess we're running a few minutes late, but we should aspire, if possible, to get back by around 1:30. And I'd like to remind you that you can come and meet our product teams in the networking space. Our reporters, some of them are still running around chasing scoops, so please connect them with them when you can. Yeah, and this afternoon, we'll turn our attention to Europe's strategy. A deeply important conversation and one that's been keeping EU decision makers awake at night. So let's talk about that. Have a wonderful lunch and happy networking, and see you afterwards. Thank you.
Are united in diversity. We are very heterogeneous in our opinion.
We are doing this in our open democracies. Discussion is all open and loud, and I'm not for that.
What is European Union?